those rules, impairment rules, didn't quite make sense for these types of assets because these are supposed to be the most liquid assets on Earth.
Hey guys, welcome to the Texas Blockcast. I'm Lee Bratcher, the president of Texas Blockchain Council. I am here with one of our longtime members and now a board member of the Texas Blockchain Council. But more importantly, he is the chair of the digital assets practice at Weaver. That is the one and only Tim Savage. Many of you will probably know Tim for his thought leadership, but if you don't, you should look him up. Tim, thanks for being on the show.
Yeah, Lee, thanks so much for having me on. Really excited to do this with you.
Well, this is an important conversation. You know, it's an educational conversation. I think there's a lot of podcast episodes that we do where the conversation is fun and it's interesting. This is going to be fun and interesting, but not only that, it's also going to be imperative that the listeners understand these concepts for their own businesses. So I think we're hitting on all sides here. It's going to be very effective. We're going to be talking about tax and audit. We're going to be talking about the FASB rules. We're going to be talking about potential de minimis exemptions. So Tim is an expert on these topics. And so, Tim, before we jump into all that, could you give us a little bit of background on you and how you got to where you are chairing the digital assets practice there at Weaver?
Yeah, so I'm a tax partner at Weaver, which is a top 30 public accounting firm in the United States, and we are coast to coast, so LA to New York, but heavily based in Texas. It's our headquarters. We've been around for about the last 70 years or so. So started in Fort Worth and now headquartered in Houston, but I sit in the Dallas office. And um, crypto assets or digital assets, whatever you want to call them, has been something that I've been interested in since as early as 2017. I was first introduced to Bitcoin in 2012, really. One of my best friends in college actually came up to me in 2012 and said, "Hey, you should check out this Bitcoin thing." And in my defense, he didn't explain it super well. So I kind of just passed over and said, it kind of sounds like a fad. I'm not too interested. Fast forward to 2017, I'm working at Ernst & Young, and a couple of my buddies are day trading random, altcoins, and that kind of got me into just, what are these things? And it was fun, but didn't really understand what I was trading. And it took me about 2 years to really, want to understand what is some of the technology underlying the assets. And even then, 2018, 19, I still had glossed over Bitcoin. And, I kind of thought it was going to be version one of something way down the road. So I was definitely wrong because, when around 2020, as a lot of other people around the same time kind of started realizing, gosh, our monetary system's got some real issues. How much of this is sustainable, and that kind of leads you down all the different paths of education and understanding not only our monetary system, but what is Bitcoin and what are these different assets. So I'd say around early 2020 is when I converted into a Bitcoiner, and at the same time I was on my path to making partner at Weaver. And we had a cryptocurrency task force at the time where we were really studying the market and some business opportunities for our firm to jump into the market, or whether we should. And around that same time, I kind of raised my hand and said to the CEO and also our executive committee, "Hey, I'd really like to start a practice in this area." And there are three key points where I think we can really drive our focus. So the first being investment funds, so hedge funds, private equity, and VCs who are in this space. That's a large pillar of what we do. And then definitely Bitcoin mining, obviously based in Texas. It's the hub of mining now. And, we've developed some really key relationships with the public miners as well as the large private miners. And, it's an industry that we really believe in and continue to focus on. And then the third is just what I call blockchain operators. These are more your fintech and kind of blockchain Web3 type companies. And a lot of these are startups. So we're basically helping them get off the ground.
Awesome. Well, when you stand up a practice like that, it takes usually years, right, before that's a profitable business unit of the firm. I know you can't share information about that, but can you say anything about the speed at which you feel like this practice has taken off for you guys? Has it been slower in the bear market, or have you been growing through the bear market and are looking forward to perhaps a 2024 bull market, or is it really not dependent on that kind of thing? Everybody's got to do tax and accounting work every year, regardless of bear or bull market.
I would say my initial response to that is all of the above are true. But to get more nuanced into it, accounting and tax compliance and planning especially are fairly recession-proof industries, because as long as we have our current tax regime, people have to file tax returns. Businesses especially become very complex very quickly, especially in this area. Particular to digital assets, let's see, we've had the practice for just over 2 years and had a really stellar first year. I can't disclose numbers on our revenue, but it was not an immaterial part of our financial services practice, or just compared to some of our other industry groups for a first year industry. And we grew at 100%, and we're targeting 250% growth for this fiscal year, which we're on a summer fiscal year compared to calendar year end.
That's incredible.
Yeah, we absolutely had a lot of growth during the last first 2 years of the last halving cycle. Definitely slowed down, especially on the investment fund side, in the last really year, in what I call the post FTX environment. There was a lot more regulation, of course, passing by the SEC and some of our regulators, as well as things like our insurance companies, the insurers of CPA firms want to make sure that the firms that are practicing in this area have good practices and are qualified and have the right procedures in place for how they're measuring risk for companies in the space. So all of those things combined, yes, that did lead to some slowdown, but again, we're still growing very quickly. And some of that has to do with other firms are not yet qualified to be in the space. Other firms don't want to be in the space. But where, I guess where there's perceived risk for those who don't understand the industry, there's just a lot of opportunity for those who do understand it and can play or can serve safely and be able to have the right practices in place to be able to work.
That's awesome. Well, I'm really glad to hear that. Okay, now let's dive into some of these recent, industry guidances that were put out by a variety of different groups. Let's start out with FASB. We've been waiting on this for a long time. The fair market value reg. Previously, you couldn't mark to market, right? You were only taking impairments, and correct me if my terminology is off. And now FASB has implemented this rule change. When do you think, has that already gone into effect? When does that go into effect? If my memory serves, they made the rule change, but it hasn't gone into effect yet. Is that correct? Or did it go into effect recently? Maybe there was like 6 months where we were waiting for it to go into effect.
Yeah, so it's essentially going into effect soon. Maybe to backtrack a little bit on just why we have this. The people who are listening to this are probably familiar with Michael Saylor. He's been saying this for the last couple of years now. I've been saying it since I first understood the industry. Is these assets are currently and continue to have broadening trading markets. You can hop on pretty much any exchange. That's the purpose of exchanges, right? Is they're brokering an exchange between person A and B, or pools of assets to be able to facilitate exchange of value. And that just naturally, because of that, you would think, hey, if any company who especially is publicly traded, or any company who buys these assets and adheres to generally accepted accounting principles, GAAP accounting, which is our main form of accounting in the US, you would think these assets should be marked to market up and down if they're being held for, for sale or for trading purposes. Um, but actually, before we had the regs in place right now, the FASB kind of said, hey, we think these are quote unquote intangible assets. And they are intangible because they're not physical assets. But the body of accounting that wraps intangible assets up into is you have to treat them under the impairment rules, meaning that if let's say you buy Bitcoin and hold it on balance sheet, well, you actually can't mark that to market or mark to fair value as of your accounting period. So whether it's quarterly, monthly, whatever. Instead, you have to do these really complex calculations that look at market valuation, that look at potentially future cash flows, things like that, and then compare that to your carrying value on balance sheet. And if it's lower, you're going to mark it down. That hits your P&L. You can never mark it back up until you actually dispose of the asset or sell it.
Yeah.
And so those rules, impairment rules, didn't quite make sense for these types of assets because these are supposed to be the most liquid assets on earth. I think a growing number of accountants or practitioners really, kind of raised their hand and said, hey, FASB, we need to have fair value accounting for these assets. And thankfully, that happened. Things have moved fairly quickly. And we had some proposed regs almost a year ago on the docket that the FASB really prioritized and saying, hey, we got to get these pushed out soon. And so I think it was about March, we had the proposed regs come out, and then there was a commentary period for several months. And now the FASB unanimously voted to pass those regs. And I do expect they come online here in the next couple of months. It could be by end of year that we have the final regs. And then that will mean that, there will be a set date, likely 2025 or mid 24, that they are effective, and then you could early adopt them if you want. Long story short.
So when you say early adopt them if you want, does that mean you could adopt them starting like January 1 potentially, when January 1, 2024? Is that possible?
Yeah, I think so. I'll have to go back and look at the actual effective date, but typically when you have a big accounting standard update like that, the FASB says, okay, it is effective for public companies by X date. Private companies will usually get a year, possibly 2 years after that date to implement, or you can go ahead and early adopt it now. So as long as you're following the procedures and the guidance, you can implement those rules today.
Okay, that's
so you can imagine companies like MicroStrategy, Block, certainly even Tesla. They will want to adopt these accounting regs very, very quickly because they can now mark assets back up. But it does come with a number of procedural changes that are going to be time consuming to be able to first initiate. So you have to, break out any activity related to digital assets. You've got to break that in separate footnote tables in the financial statements. You've got to really have some narration, some explanation on what are you doing in the space, and how they're generating cash flows, or what are you are you investing in them. You basically got to be transparent about how you're interacting with these assets.
Okay, that's a very helpful primer on these updated rules, and we'll be anxiously awaiting when companies are able to mark to market for these assets. So transitioning from FASB to other tax, I guess more transitioning from the accounting to the IRS side of things, de minimis exemptions is something that I think has plagued, the lack of a de minimis exemption has plagued the industry since its inception. Do you think that is possible in the next few years, where we could see like a foreign currency style de minimis exemption for digital asset commodities like Bitcoin? I'm sure they won't do one for digital asset securities, or maybe they will. Unlikely. I think digital asset commodities probably have a better chance of getting a de minimis exemption. So is that something where you see that Patrick McHenry's market structure bill needs to be passed before we would get a de minimis exemption, or what's the latest on that topic?
Yeah, so I think it's possible that we could see something passed at the federal level. I think, well, sorry, within the next few years, I think states would actually be more likely, Texas in particular, to pass something sooner than that, because states tend to be more nimble. Um,
So help me
we,
understand. I thought this was only a federal issue. Can states affect de minimis tax
well, you
topics?
probably need to discuss that with some lawyers before I can answer that, because the rights between the states and the government, sorry, the federal government on whether, these assets are considered money essentially, and whether de minimis rules would apply is one issue. But yeah, I guess specific to tax, this would be a federal IRS
So I
tax
guess what
issue.
you're saying is
Yeah.
if a state deemed a digital asset commodity to be money, then it would fall under existing federal guidelines that it would then be included in de minimis tax rules, and therefore there would be no federal change needed if a state. Now, the constitutional question then comes up, is I think that's what you're saying, is there's a constitutional question about whether a state can determine that an asset is money or not.
Yeah, there's certainly the constitutional issue. That's more, what I was hinting at. But states also have their own tax regimes. Texas doesn't have an individual tax. We have a franchise and many other types of taxes, but um, you know, almost every other state does have a state income tax, and uh, they are able to pass their own rules on whether they consider something to be treated the same as federal treatment, or if they have their own more specific state rules. And there's many variations of that. So digital assets in particular, a state could have a de minimis rule, for a personal individual income tax rule, or even like a corporate level tax rule. So states still have the flexibility in having their own modifications on their own tax law.
So let me throw a question at you, and I don't know if the audience is as interested in this as I am, but they probably are. So if there was a company or an individual in California that wanted to do business in Texas, but they had some assets that were the transaction of which would incur normally a capital gains obligation, tax obligation to them, and they decided to do business in Texas, and say Texas had passed a de minimis exemption, um, or there was perhaps like a company relocation to Texas, since we don't have like state level capital gains tax, where I think in California does have state level capital gains tax. Are there any advantages to us passing something that like that here, even though we don't have that state level capital gains tax? I guess what I'm getting at is, could we attract more businesses from California by changing our tax treatment, even though it really wouldn't affect companies domiciled here, but it might attract other companies that are currently under a different tax regime, like in California, say?
It's a great thought. I would say at the business level that probably like a de minimis tax exemption for digital assets probably would not be the game changer to attract a company from California to
It'd have to be a
Texas.
payments company that has a lot of
Yeah,
small transactions.
right. Like this is not something that they particularly care about. But it's more specific to capital gains. Yes, many states do have capital gains rules on how the gains are sourced to which state. Texas in particular, it's possible to source capital gains outside the state, depending on where the transaction occurs or where performance is occurring. And there's a lot of very specific state taxation rules. But I like where your thought is going into how can we attract more companies to come here. Ultimately, that you know depends more on the local economies, what kind of tax breaks that your cities and jurisdictions are going to provide. our employees going to be more happy? So yeah, a de minimis tax is not going to be the game changer for attracting someone. But that really the heart of the question is, why would we need a de minimis tax, right? And that's really, the looking at the function of money. You want money that's, of course, a store of value that's used as a unit of account and a medium of exchange. It also needs to be adopted or demanded and accessible and have all these different kinds of traits. How can you take a digital asset, I'm going to use Bitcoin, the best money, and how do you take Bitcoin and move it from being a store of value into having these other use cases actually being utilized? So a medium of exchange and a unit of account. Well, you have to be able to make it interactable and transactable. It definitely is right now, but of course it's not the fastest in settlement. Although settlement finalizes within 10 minutes typically, but still you want something that's instant. So as Lightning continues to proliferate, we're going to have that scalability solution. Well, now people are going to want to actually transact back and forth. Not only that, but across borders too. So does it make sense then for, technology has evolved, continues to evolve into where, okay, people can use this, but now you're going to have this burden of tax. Like you've got to calculate your gains and losses every time you use it. And if you're using Lightning, it's not going to typically be for transactions over a few $100s. Yeah, de minimis exemption certainly makes sense in that case. If you go buy your pizza or cup of coffee or whatever, yeah, it's called de minimis, and you don't have to extrapolate all the detail of the time of payment, the value at the time of payment, and the quantity sold. That just makes it a lot easier from an administration perspective.
Yeah, I'd say so. Well, speculating into the future, when do you think we might foreseeably see something like that? Obviously, the type of de minimis exemption that we're now talking about is the federal statute. So it would require an expansion of de minimis rules, or it would require the United States to recognize Bitcoin as money. One of the two, it sounds like. So do you think that's on the radar in the next 10 years, 5 years, 2 years? What's your thought process
Gosh,
there?
it's very hard to look out 10 years from now with any certainty. I would like to think that by then we have some rules in place, just kind of looking at adoption rates running along Metcalfe's law. It certainly seems like by then we'll be at around 50% of actual adoption. Lightning won't be quite as brittle. It'll be more robust. And you're going to have other payment solutions being built on top of many different networks. 5 years out from now, I think is when we would probably see things really gaining traction, because we've got to get through primaries right now and presidential regime changes. And typically it's within the first 90 days to a year of a new president or reelected president for that agenda to be chalked up and then pushed out. And then you've got to look at bills running through Congress and basically all the macro cycles for when is something going to get passed. And thankfully we've seen you mentioned Patrick McHenry, some of his work, but also Senators Gillibrand and Lummis with the Responsible Financial Innovations Act. They had specifically a de minimis threshold of, I think it was $200. Now those bills, V2 was very good. It was very comprehensive. And I think that is probably one of the best shots we have at getting a de minimis and a lot of other items that are important to get passed on the Hill.
I think that it was not included, though, in the House version of the FIT Act, which is the old market structure bill.
Yeah, the one that McHenry didn't author that one, right? It was
it came out of his committee. I think it was French Hill and Thompson, if I'm not mistaken. So
yeah, that's right.
So really, that's a good bill. We support it, but the Lummis Gillibrand bill is a better bill almost on this topic.
Yeah, I would say, the Hill bill that came out of McHenry's committee was more focused on stable coins, I think. And yeah, the V2 Responsible Financial Innovations Act was a lot more comprehensive. V1 was kind of like the ideas were amalgamated, but then they went through further iteration, and then V2 was produced, and it was a lot more robust. And yes, I agree. I think it is the best shot at a number of good things that need to be passed, inclusive of a de minimis exemption.
Yeah, man, that would be so helpful. Just increases adoption, here in the U.S. Of course, that issue is not a challenge for our friends internationally for most jurisdictions, right? I probably in some jurisdictions in Europe or the EU, I mean, could be an issue, but when we're seeing adoption in the developing world so quickly, they're not really having to worry about that. So that's good. But okay, what are some other issues related to tax and accounting that our members should be aware of, our listeners should be aware of, that are sort of things that you're aware of just because it's your profession and because you're in it every day, that the average person in this industry does not know about?
Yeah, so I'll say one that's not particular to accounting and tax, and then I'll go more into the accounting side of things. But in any industry, and I said this at Bitcoin 2023, but in any industry, you typically see a consolidation as industries mature. So take healthcare, for example, insurance companies gradually collapsing into the larger ones, oil and gas, same thing, professional services, same thing. I mean, any industry as it matures, things tend towards consolidation. I think we'll see that in mining specifically, as well as whoever, the exchanges. We're seeing that right now. But yeah, the brokers and whatever new markets get stood up for tokenization, we're going to see a few major players start to dominate the industry. What I am a little bit fearful of is mining pools going through that same consolidation, because they will. And right now the industry is pretty good at self-regulating, or monitoring that and making sure that if the chance of a 51% attack ever happened, whatever that could look like through a mining pool, that we just don't get there. So should we consider regulation or some kind of something, right, that helps us, that prevents that from ever happening? Because that would be the black swan that I see, or could see happening to Bitcoin, is your mining pools are attacked in a way that we've not seen before. And if that happens, that could, imagine mining going offline in current state. That would really disrupt a lot of things. Now, thankfully, with the difficulty adjustment, things could get up and running relatively quickly, but you just don't want to be in a position where something like that could happen.
Yeah, 100% agree. So I wonder, since some of the largest pools in the world are in China and the U.S., I wonder if that it's even possible for the U.S. to, I guess they could tie some sort of mining legislation or policy to a prerequisite that the U.S. pools are neither pool or neither of the large U.S. pools are over 25% of the total hash rate. Or there could be something there, but I think that's going to have to be sort of a self-regulatory effort for the next several years, because I don't think the government's even thinking about that yet.
Right. I don't think most people are thinking about that. And I mean, this gets really into game theoretics, right? But I think that whatever jurisdiction you're in, the mentality is like, yes, we're going to do this for ourselves, but we're also all in it together, right? And if any one bad thing happens to the network, that's bad for all of us. So we should work together to be self-unified and identify this issue ahead of the time, and have some procedures in place that prevent that, so that we don't have another FTX type situation where it gets out of hand And now we're dealing with the repercussions of, basically the regulators or the powers that be saying, you can and can't do this now.
Yeah.
Um, so that's one thing. And then more accounting and tax related would be, we spoke on fair value accounting. That's certainly important. I like to look forward 5 years, 10 years, speculate, like we were talking about. If Bitcoin does become a money, actually recognized form of money in the United States or internationally, adoption rates continue. You reach that inflection point where volatility starts really decreasing at a significant pace because your market cap is so large, and it is being transacted with high volume. So it's not just speculators or people holding onto the asset and then traders, adjusting the price. It's more, actually used as money. Well, if that's the case, that impacts the accounting rules quite a bit, because then you've got to look at, okay, we've got this asset that's historically been, you can trade it on a market, but also now it's being used as money. So should it be treated as a cash equivalent, or should it stay on as an investment asset? And it could be both. What about miners though? Like, how are they going to treat their ASICs? So ASICs right now also are under the impairment rules, and there's some pretty complex calculations for how you look at impairment for ASICs. Should those be, right now they're being discounted based on present value of future cash flow. Like, can an ASIC produce enough cash flow discounted today to justify its market rate? And then you can apply similar logic and calculations to digital assets held on balance sheet. Are they generating yield or whatever cash flow you can generate? My point is, the classification of the type of asset greatly affects the accounting impact. And so these are things that FASB and the IRS and all practitioners in the space need to be thinking about. Is, okay, fair value's in place, but is there ever a point to where now it's not needed? Or do we need to create new formulas, new kind of models, financial models, instead of maybe a discounted cash flow? Do you need a premium cash flow because you have the scarce asset that gains purchasing power for the first time in history? That's a different model than anything we've seen. So, it's fun to kind of think out, by 2032 or whenever we think critical mass is achieved, that will really change the finance and accounting models that we use today.
That's fascinating. Well, it's a long road. I think you are spot on with decreased volatility as volume increases, as adoption increases, the volatility swings become less severe. And they would need to, for the government to be comfortable with the de minimis exemptions or treatment as money or moving it out of an investment, asset. If the volatility remains where it is, I could see the legislature, the Congress, and the IRS saying that's just a gift to people that are investing early in Bitcoin. So I don't know. I obviously those are different categories: the de minimis versus the treatment as money. One of them has far greater implications for taxes, but a lot to ponder.
Yeah, it's really the question of, it's the chicken and egg issue, right? Is adoption happen first and then regulations or rules change, or do you do them now so that you can encourage adoption? And I think, unfortunately, we're going to see the former happen. Is we have to prove ourselves, things have to actually adapt and upgrade.
Yeah.
And adoption needs to happen, and then your rules are going to change.
Yeah. Well, so in between now and then, like when those of us who have Lightning wallets and we spend Bitcoin on something, if I'm buying a ticket to a concert from a buddy and I pay him in Bitcoin, technically I'm supposed to pay a capital gains on that. Like, but there's just no way that I can calculate that right now, right? So what happens? I mean, I guess your answer is probably, well, you need to, but we
That is
know
my
that
answer. Yeah.
99% of Lightning transactions are just happening. And, unless there's some, accounting software, massive jumps in accounting software capabilities, I don't know what's what's going to happen.
Yeah, so the answer is you need to. Our tax system is a self-reporting system by nature, meaning that you do all your transactions and then every year you report them to the IRS. And that includes any type of taxable event for assets that aren't brokered through a regulated exchange or whatever. That includes gifts, that includes um, many other things. So you would have to either keep good records yourself or use some kind of software that's maybe capable of tracking that for you. Weaver has partnerships with Coin Tracker and Luca. That's the software products we use, and both continue to improve very quickly. But are they robust enough to capture every single Lightning transaction? Well, maybe not. It's only as good as the information that we receive from our clients, right? Like you've got to go and pull out the information that we don't know about, and then we can help you calculate that.
Hmm. That's
But it
interesting.
is difficult. It's a huge burden, and we do need a de minimis exemption to really encourage at the cheapest levels or for not expensive goods and services to be able to let people use these assets.
Right. That is number one priority as it relates to taxation, in my opinion, is this de minimis issue. In the meantime, it sounds like I know there's, you mentioned Coin Tracker, there's TaxBit, there's a lot of other good software programs. So I know for these assets that you can link them through API, I guess, to your exchange, but not to your wallets. Is that correct?
You can. I mean, you can take public keys, and SegWit wallets are a little more difficult because every transaction is may or may not come out of the same wallet,
What about
initial
a
address.
what about a Lightning wallet?
Um, yeah,
That's
that's a good question. I haven't done as many Lightning transactions, so I need to visit that some more.
okay. And then so SegWit also has a challenge because of the different nature of the wallets that the UTXOs could be coming from.
Yeah, exactly. But Ethereum wallets, for example, they're pretty easy to track because you can pull up any block explorer and trace it all the way down to Genesis. Um, and so, yeah, you can pull in wallet transactions as long as you have that history, the ledger essentially of the wallet transactions on public, on a public database like a block explorer. That's step one. Um, but there's so many holes that we see with our clients that like the software just can't pick it up, or they're trading NFTs or something, some kind of illiquid asset or made up asset that's not actually traded. Airdrops are an issue. um, Not being able to find basis from way back when the assets didn't have that information
Right.
available. So yeah, there's a lot of holes, and thankfully the IRS does allow the use of estimates in certain cases, like when information just is not available.
Right.
Um, and if you are in good faith, really trying to report correctly, there's a lot of grace for that. But if there's a hint of negligence or fraud, the IRS does not like that. So you should
Sure.
not. You should always report. You should always, in good faith, really try to do the right thing.
Yeah. Yeah. Well, it's so important that people have experts and professionals like you guys, like some of the others that we've mentioned on the show, both on the advisory side, on the tax side, on the software side, to consult, because getting on the wrong side of the IRS is the last thing that any of us have time for. So
That's right. It's never fun to go through an audit.
Agreed. Agreed. Well, Tim, where can people go to find more about you or about the practice that you lead at Weaver?
So if you go to weaver.com, you can pull up either, if you go to About and People, you can pull up my bio. Also just industries, you'll see very alphabetically, blockchain and digital assets is an industry on our page. You can click through that and see how we serve clients in the industry and some of the key leaders in our firm, which we have some really heavy hitters who are deeply involved in the space. So we've got a great team. We've got just over 35 right now, and we're
That's
building.
awesome. That's awesome. That's a big practice for the digital asset industry. I'm not aware of very many firms. I mean, of course, probably like Deloitte has a massive
Yeah,
practice.
the big four have they all have very established practices at this point.
Yeah. But as far as like, top 30, top 25 firms, you're probably heavily weighted relative to some of your peers, and even on a per capita basis against Deloitte. I mean, Deloitte's just a massive firm, so relatively their digital asset practice might actually be smaller than y'all's on a relative basis.
Yeah, I don't know. I would hesitate to say that still because Deloitte is an absolute thought leader in the space. They produce some very robust, good reports. PwC has a great practice. KPMG, EY is specifically only focused on Ethereum, so that's what they do. It's their bread and butter.
Interesting.
But yeah, their practice is thriving. So yeah, I mean the big four firms are very much in the space.
Yeah.
And they're working with your BlackRocks and your Fidelity and the major players and bringing this to life at the highest institutional levels too.
It's exciting times to be in the industry. Tim, thanks for being on the show, and we'll look forward to seeing you and many of your colleagues at the summit.
Sounds good. Thanks for having me on, Lee.
Hey y'all, Lee Bratcher here with the Texas Blockchain Council. Thanks for watching. Be sure to like and subscribe. It really does help other people find us. If you like this content, check out the Texas Blockchain Council YouTube channel, as well as following us on TikTok, Instagram, YouTube, and Twitter.